Hello, thanks so much for tuning in. This is Rachel Burns, and I am a certified financial planner, certified divorce financial analyst, and my firm is called True Worth Financial Planning, which helps newly single women get their finances back on track after either a divorce or after the death of a spouse. And today I'm going to be joined by a very special co-host, Nick Fendig. I am bringing him on with me right now. If I can remember how to do that, it'll be just a second. But Nick is a consultant based in Florida, and he works with a lot of people. Oh, yay, there you are. Hey, Nick.
Figured it out.
All right. No technical difficulties today.
No, no.
So, you're a little bit quiet, Nick. Or maybe it's just me.
Uh,
Maybe it's me. Anyways, I was just kind of introducing you. So, Nick is based in a town in Florida that I can't really pronounce. You want to say it for me?
Jacksonville, Florida. So
Oh,
Northeast
that's
Florida.
that's easy. I was talking about the Fernandina.
Fernandina, Fernandina Beach. Yeah.
That one's
Yeah,
a
we'll just stick.
mouthful.
Yeah, we'll just stick with Jacksonville.
Okay, that's way easier.
Yeah.
So, yeah, I was just mentioning that you are a lender and you work with a lot of people who are going through a divorce. And as a result, you have some great insights into how someone can protect their credit score, how they can build it up, which is especially important after a divorce because when you're on your own, it's just you, it's just your credit.
Yep.
You're no longer, co-borrowing with someone. So it's really, really important. And even if you're not buying a home or refinancing a home, it's still your credit score is still a very important asset. It's going to impact what it costs you to borrow money in the future. So it's something you need to be thinking about, even if you don't have any plans of taking out a loan.
Yeah.
So, so I would love to hand it over to you and have you share some of your infinite wisdom with us.
No, and thank you for having me. Yeah, credit is, it's funny. I've been doing this now for 5 years and I still learn a lot of things with it. And credit was, it's surprising because there's not a lot known about it. Even, as an adult, when I got into the industry, I was like, holy smokes, I've been living my life oblivious to this aspect. It's not super complicated. It doesn't have to be. With anybody I tell to, just a good kind of a good personal finance thing to always keep in mind is, you can check your credit once a year for free, and you can actually get a real FICO report. It's a lot different than a lot of things. The website, so I make sure I've got it pulled up. I just want to make sure, but I advise people again, whether buying a home or whatever, but keeping an idea of stuff is going to annualcreditreport.com. You can get a free credit report once a year. Right now, because of COVID, I think you can still get one weekly. Um,
Oh,
and it's a
nice.
Yeah, it's a soft check. It's not going to generate you a credit score, but the really important thing in this is it's going to show you everything that's reporting to your credit over your entire history. And that's a lot different than a lot of the other free things that are out there that generate a score. Is sometimes certain things don't pop on those models. They're when it comes to credit models, there's, the last number I heard, there's like over 50 different models. So credit reports, credit cards may or may not report to, all three of the credit bureaus, TransUnion, Equifax, and Experian. So this is just a good thing for anyone in the middle of a divorce, after a divorce, and it'll show you the good, bad, and the ugly. So you can, start addressing, and getting things corrected from there. So definitely something everyone should keep in mind.
So you mentioned that that's not going to give you the score. What's a good way for them to keep track of what their score is?
Um, Good thing to do with a score. And to a degree, it does depend. If you're going to be borrowing money for something. So if you are getting, say, a credit card or a boat loan or a mortgage, each entity is going to have its own specific credit model that they have to use. For your everyday kind of monitoring, a service like Credit Karma, certain credit cards will give you kind of a score of one of the three bureaus. Those are good to kind of keep an eye on it, because if something happens, they update once a month. If you see a big drop, that gives you kind of an idea that something has happened. You may want to address it, look into it. If you haven't pulled a free FICO report, maybe that would be a good time at the moment. But for scores, the best thing, especially if people, it's concerned of how to increase their scores, really you have to break down what creates a credit score. And there's really about five main principles. And those are, one, the largest thing that makes up someone's credit score is going to be some payment history. Making sure you're making your payments on time, no lates, no, nothing like that. That's 35% of your score. And then 30% is going to be your amounts owed, about how much, so if it's a credit card, are you maxing out that card? Are you keeping the balances low? But I mean, those two things, that's more than half the credit score profile. That's going to really make or break someone's credit profile. And then some of the other smaller aspects are going to be, length of your credit history. That's about 15%. So the longer you've had credit, and making sure you're focusing on your payment history, but the longer you've had credit responsibly, you've been using the little bit you have well, that's going to help you as well. And then things like new accounts can have a small impact. And then lastly is going to be kind of your overall profile of credit. So there's there's a couple of different ways we look at it. So credit cards, we call them revolving because they're always open. They're always continually opening. And then you have things like car loans, which are installment loans. There's a beginning and end. And then, mortgages. So you don't want to have, a bunch of just credit cards. That's only one type of credit, but having kind of a mixture of different types of credit, using it responsibly, that'll have a small impact in your scores as well.
And I just wanted to chime in. I learned one of those things that you said the hard way. So I really like the Marie Kondo concept of life in general, just keeping things tidy and neat. And so it really annoyed me when I would look at my credit report and I would see these like credit cards that I had when I was 20 years old, and it would just bug me. And so I wanted to close them so I could have this nice, pretty credit report. But what I didn't realize is that I was then losing all of that good history associated with those cards where I had been paying it off, on time for all those years. And I was like, kind of shocked when I saw my own credit score. Not that it's bad, my credit score is not bad at all, but
yeah,
I was like, I should have a perfect credit score. But it's what's kind of interesting about credit scores. It's not in my opinion, it's not the most accurate evaluation of your financial situation, because if you're someone who is in such a good situation that you don't have any need to borrow, then you're not going to have credit, which makes you look not so credit worthy, which is kind of backwards. Like, I get it. I get that they have to use some sort of metric to determine how safe you are to lend to. And like your history of paying something is very important, obviously. But it's just kind of funny that you can think that, oh, I'm in a really good financial situation, but there still might be things that you should do that you can really boost your credit score that are not super obvious.
Yeah, there's definitely, and you really hit the nail on the head. I mean, there's some of this is almost counterintuitive. Just like you said, with closing a credit card, you would think, I'm not using it, it shouldn't matter, if I close it. And, it does. And it's weird. I mean, at the end of the day, these are just massive algorithms, massive computer models. And so just the way that information gets processed, and again, I think it should be a little bit easier. And there's, again, some things that just don't make sense about it.
Yeah.
Closing, and we see that happen a lot, especially with working with somebody buying a home is, similar situation. They may have a lot of credit cards. And just a good rule of thumb is if you have credit cards and you're thinking, I haven't used this card, I don't really need to use this card, that's totally fine. Leave it open. Don't you go and close it. If your creditor does due to inactivity and kind of that counterintuitive thing, if they close it, it won't affect you. But if you close it, then you cut that history off from you. And again, it's the same action, just done by somebody differently.
Yeah.
So, but no, I mean, using most times I just tell people, if you have a card, use it for your gas and groceries, keep it active. Sometimes even small things too, is you would think not having a balance on a card would be more beneficial. Sometimes showing activity with credit can be a bit more positive actually in comparison.
So is it just showing activity, or is it maintaining a balance that they actually want to see? Like if you're using your card regularly but paying it off every month, is that as good as someone who has a small balance that they keep month over month on their card?
I would say it's probably a bit of both. I mean, really, if you're using it and you're paying it off at the end of the month, or if you leave a small balance, those are both going to be positive things. You're not overextending yourself. You're not increasing your amounts owed to a dangerous level. Credit cards are easy in that sense because, we know we have a max budget and a minimum. So you want to stay under 25% generally. But using it active, for minor expenses, things you could pay cash for, use for your debit card, just replace with your credit card. And yeah, it's a little kind of backwards sometimes,
It is.
You learn a few of these things, you start implementing them, and it'll pay off in the long run for sure.
And back to what you were saying about the balances on each, like they're concerned with the credit utilization ratio. So of your limits, how much of that limit are you actually using? I know that's really important. But what I think is tricky is they give you this limit. So let's say you have a limit of $1,000 on your credit card. That doesn't mean you should just go use $1,000. It's like,
yeah,
this is the limit, but like, don't get anywhere near the limit. But it's kind of, it's like, why even tell us that that's the limit? Give us the real limit. But yeah. I think that's important to know. If you don't get this false sense of security because you're staying within your limits, so to speak, but if you're showing that you're using a high percentage of your available credit, then that's not a good sign on their part. And also,
definitely
I was wondering,
not in the long run.
Yeah, and then I was wondering if you have, let's say, if your credit utilization ratio is a little higher than it should be, so you have a little bit more, greater portion of your limit that's actually outstanding, would it benefit you to try to get your credit line increased?
Yeah, that's absolutely a great way to do that is then going to your, whoever your credit card company is and seeing if you can get it, especially if you have a very good record and history with them. Very quickly. And then, it dramatically can shift that utilization ratio. And then, what was, say, 90% could then drop down to like 10% utilization. But yeah, that's sometimes something we've done to kind of help change somebody's credit score real quick.
Yeah.
Absolutely.
Interesting. So if you request that, will the fact that you have asked for that credit increase, is that a ding on your credit in itself?
No, that's a good question. I would say it wouldn't be, because you're not necessarily applying for new debt. If anything, it's your original creditor saying, hey, yeah, actually, you know what, we think you're qualified enough and responsible enough. Yeah, we're happy to increase your limit. So, but I would actually, I know I've done it in the past and I've never seen negative stuff, but that might be too specific. Or anecdotal.
Yeah, I was thinking of experimenting with my own. I was like, because I really want a perfect score. I got I like getting good grades. And just because I don't use credit doesn't mean I'm not a good risk. And
Yeah.
like I haven't bought a car in a really, the last car I bought was cash, and I don't like that I don't have as high of a credit score as I could. But I was thinking like, well, maybe if I called and asked for a higher credit limit with no intent of ever using it, maybe that would help, my own little personal scorekeeping in my mind. But maybe
Yeah.
that would be a waste
I've
of time.
I know, yeah, I've only seen in my career, I've only seen one gentleman with a perfect score, and he was 70 years old. He had paid off a mortgage. I mean, there's the with when it comes to scores and things like that. I mean, yes, higher can always be better, because credit can affect other things, like even your insurance,
Yeah.
whether it's your car insurance, things like that. It's credit's an indicator they use. Um, the perfect score, I mean, those tier you've probably seen tiers of like, if you're under heat, if you're in this bracket, you're okay. If you're in this bracket, you're good, and so on. But generally, if you're pushing 760 plus credit scores, you really are in one of the top 1% tier. And that goes back to the kind of the breakdown of someone's credit is, length of credit history. So,
Yeah.
I mean, you keep doing what you're doing and response, and everything. And yeah, and in, a few years, you may be like that A plus plus there. So,
Well, I'm waiting for that A plus plus, and I will earn it one of these days. Um, yeah, and with the credit, with the making the payments on time, one of the things that you can do is set up automatic payments so that if you are someone who like forgets to make payments, and that's an easy enough thing to fix with automatic payments. But what I wanted to mention about that, because I do that with I do have one credit card that I use, and it's my business credit card because I like the points. And I just have it set to pay the balance every month, which is good. It's good to prevent any potential late payments. But I do want to warn people against putting so many things on automatic payment that they kind of lose touch with their finances. So
yeah,
if you are using your credit card, you're not even looking at it at the end of the month when it's time to pay the bill because it happens automatically, then you're not even like paying attention to what you're spending. You're not paying attention to what your overall financial situation looks like. So if you're going to be doing things like that to help your credit score, if you're going to sign up for automatic payments, just make sure that if it's totally fine if it's payments that are the same amount every month and you have to have it, like your garbage bill or something. But if it's a credit card and it's your personal spending, just make sure that you're still keeping an eye on it, because it's not like,
yeah.
oh, it's automatic, set it and forget it. I'm never going to pay attention to how much I'm spending. So that's kind of a pitfall that I've seen on my end.
I would have to, yeah. I mean, and going back, it's just an aspect of personal finance, maintaining your budget, knowing your budget.
Yeah.
Um, the reason I recommend, because especially auto pay for people is because sometimes I see people on the bad end of the credit spectrum, and just reviewing the report with them is it's just late payments, everything, and it's one of those, to a degree, a little bit of a misconception of, oh well, I was late, or I was like maybe only 2 days late because the due date was the 15th and I paid it on the 17th, and thinking there's grace there. And most credit card companies will allow a little bit of grace, especially for one infraction. But those late payments can very quickly build up, and really pull your scores down immediately. Um, I mean, I've seen people go from mid 600 score, miss a late payment on a vehicle or something, by a couple of days, and it just, dropped them 100 points.
Wow. Wow.
Yeah. There was a uh, study done by the credit bureaus. They actually did a study, and I think I've found it on their blog, FICO.com or FICO blog, something like that, and kind of a general breakdown of, if you're in this credit tier, that, like low 600s, mid 700s, 780 section, and, things like one late mortgage, 130-day late, you know, how quickly it can drop you, like significant amount, 100
Yeah.
points plus, but also in the sense of, well, how long until they can get back up to where they were? And in some cases, it takes three plus years.
Oh, geez.
So, and the way I've always explained, bad credit marks on somebody's is, if you think of it as like a physical injury, the more recent an injury, the more painful it is, but over time it starts to hurt less. And some people know about, there's a 7-year rule, and typically the more time since certain negative things have happened, they impact your scores less. But when you start those first 2 years, it can, it can be a long hike to get back where you were, in some cases. So again, maintaining that kind of responsibility of maintaining certain things, because those late payments can be quick, super
Yeah.
quick, and then you're
Yeah.
really back to square one. So
Yeah. No, that's good to know. And when you start doing these kind of smaller things to boost your credit score, it takes a while for those to actually be, for you to be able to see the difference in your credit?
yeah, if you've got things like lates, it can take really about a year to two to kind of get past that. 2 years typically is when we start to see it affect your profile, your credit profile, far less. One thing we see, definitely commonly is, collections, and this kind of goes back to, it shouldn't be this way, but unfortunately it is. We'll have somebody, they'll, say they review their credit report, they see that they have collections, and so wanting to be responsible and take ownership is, they'll start to pay these collections. And unfortunately, this is just a bad thing on the credit algorithms. Is what happens is, this collection may be, years old, and so there's what's called a date of last activity, or DLA. And so what the credit algorithm is going to read is, okay, it's going to reactivate the collection, and it's actually going to hit your credit as if a new collection has just affected you, even though you paid it off. The issue with collection agencies is, it's not the amount that you owe that affects your credit. It's actually it's the collection mark on your credit. So a lot of times, if someone's going to want to try and get those removed or addressed, is actually reaching out to the collection agency, seeing if you can get something in writing that, hey, if I, can pay, can we have this removed? And, that can be something, but really just going flat out and paying for it can actually really hurt you as well.
That's good to know, because you might think you're doing the right thing and you might be reopening old wounds.
Yes. Yeah, that's a great way to put it, unfortunately. But that's sort of why, certain systems like Credit Karma and things like that can be good, because they can pick up if there is especially something new or recent has popped up, and you can jump on it and reach out to an agency, to a collection agency, and see what's happening. The other thing too with the collection, it's really just, maybe a credit card debt, or and some, rental obligation, and something went south, and then they've sold the debt to a collection agency. So sometimes they're willing to work with you. Now I've had clients in the past that have great success with that. So,
Good. That's good that there's hope.
yeah, absolutely.
Well, is there anything else that you want to share with whoever's tuning in?
Yeah, one other, and we haven't been able to touch on, and when, I guess, credit, and it goes back to one of those, your amounts owed, is there's a new resource out there, a new group, I guess, or company, called LoanSense. And I've started to have some clients, but really what they're there to do is help provide assistance to people, with student loans, and not just, someone who has, like, they've been able to help doctors, and people who are expect to have high income, is help them reduce their overall student loan balance, and through federal grants. I was not aware that it's not necessarily how much you borrowed, but how much you can actually reasonably pay back. And so, you know, student loans are a big hindrance to anybody buying a home.
Yeah, no
And
kidding.
this is a great resource for somebody to be able to, kind of help overcome maybe that issue. So,
Yeah.
anybody out there, especially, and, just how much you may have out there, could be a big help.
Yeah, and if anyone has a substantial amount of student loans, or if you're trying to become eligible for forgiveness, like the public service loan forgiveness or something like that, it really, really pays to meet with someone who is an expert in student loans to help you come up with a strategy, whether you're trying to buy a house or not trying to buy a house, but still, like, anytime you're going to make any big financial decisions, you need someone who has expertise in student loans because they're so unique and they're so tricky. And you might think, oh, I'm doing the right thing by paying off this student loan so that I can, qualify for this. And you might be doing the wrong thing and not even know it. So I encourage people to use a lot of caution in that area, but having resources like Loan Sense, that's great to, get any
Yeah,
information.
I mean, definitely an onion type aspect of our world. And so, yeah, I mean, I haven't even been able to crack that one. And this group has become very, very big, at least in the mortgage world, just because of, how big of an issue it can be to help someone qualify, a first timer or even an existing homeowner. So helping
Yeah,
them.
because student loans are so prevalent that that's
Yeah.
something that keeps people from buying a home on the schedule that they had intended. A lot of people have to kind of delay that because they've come out of school with these massive student loans.
Yeah.
Well, anything else you want to impart before we hop off?
No, if there's anything I can help with anyone in, specifically, or answer a scenario, I'm happy, or provide a resource, or, especially guidance with uh, addressing credit or negative things, I'd be happy to help. But no, I appreciate your time. Appreciate you having me as well.
Oh, thank you so much for coming on. And yeah, if
Yeah.
anyone has any questions, first of all, you can submit questions in the comment box below, but also if you have questions afterwards for either of us, please reach out. We're super happy to be a resource. If you have, questions specific to lending and credit areas, obviously Nick is going to be the go-to guy for that. And then for anything kind of financial planning in general, whether it's related to divorce or not, I'm happy to help with that. So please reach out to us. And we'll be posting a recording of this I'll post it on my feed or my whatever you call it, and tag Nick in it. So if you guys can watch the recording if you miss any of it. But thank you so much, Nick, and thank you everyone who's tuning in or watching the recording later.
Thank
We'll
y'all.
be back. All right, thanks so much.
Have a good one.
You too.